I think a lot about the public markets in relation to the options our investors have. And the public markets have developed, and the industrial sector within the public markets has hugely expanded. It is one of the more largest and more valuable sectors. It's several times in a market weighting basis that of the office business, which is you never would have predicted that. So the markets have expanded in a significant way, and the industrial companies that are public have done very well in that business. But they operate in a different way than private equity firms do. They have some significant advantages. They do have lower cost capital. They have more efficient ways of capitalizing their activities. They have perpetual capital. They have the operating efficiencies that come with operating a large portfolio and the ability to engage with their tenants in a kind of longer duration format. So those are some advantages. But private equity also has some interesting and significant advantages. We have more flexibility with how we approach capitalizing our activity. The REITs tend to have these rigid, they're driven by ratings from the agencies and expectations from public markets, and we have more flexibility. We're also able, in the activities that we pursue, and if you're in a cycle where development makes sense, that can be the majority of what we're doing. So we're not constrained by expectations in the public markets. We're really focused more on long-term value creation. And the quality of the teams that we can assemble within our company also are attracted to the way the private equity business works. So the results for PE firms focused on the logistics sector have been very good. And it's a continuing opportunity. You've seen in other sectors outside of real estate this convergence with PE and with public markets. And that's happening to some extent in our business, but actually not as rapidly as you would expect, in part because, these REIT formats it's a tax creation. It forces you to pay out all your cash flow. You get valued on the basis of your cash flow versus total return. And it can be a limiting function. I mean, if you're in a scenario, let's say, where you're trading below NAV, the obvious thing to do if you're a public company would be to buy your shares. But that's hard to do as a public company because you're paying out all your cash flow. It'll be interesting to see in the real estate world, how these markets converge over time. But it's certainly happening now more slowly.